this is technically lecture number 4 for this course, but it is according to task number 2. If you remember in lecture 1, 2, 3, we have completed LO1. But in lecture number 2, basically lecture number 4, I'll be making and deciding the classes according to task number 2 from your assignment brief. Is this clear and okay to you people?
Yeah, yes, ma'am.
Yes, ma'am.
Okay, let's start with it. Basically, in task 2, we are having one assessment criteria from 2.1 and two assessment criteria from LO3, and that combines task 2. So that is why first we will be focusing on 2.1 today in detail, and then step by step we will be moving for 3.1 and 3D1 respectively. All right. Analyze the components. The command verb is analyze, on which we will be focusing. The question is asking about the components of working capital, explaining how business organizations can effectively manage working capital. So the first thing in this question, in this assessment criteria, is about the components of the WC, and the second thing is the effective management of the working capital. So we will see that what working capital is, then what's the components, the important key aspects are, and then eventually we will be doing the management of the affection related to the working capital as well. I will be explaining the slides to you, but in the end, I added the example of the organization Apple. It is for your people. Like, you have to read it, and we can discuss it later on as well. Okay. Working capital is a crucial aspect of financial management for any business or organization. It refers to the capital available for day-to-day operations and is essential for managing liquidity and operational efficiency. This paper analyzes the different components of working capital. Basically, the whole question is talking about this. We can even eliminate this part as well. No need to discuss it right now. We will do this in the assignment brief class. Working capital in general is what? Everything which is going on the daily basis in an organization, we will be recording it, and whatever the activities are going on, that is known as working capital. Now in this, what do we have? We have to manage the liquidity. That is the incoming of the cash assets, cash flows and outflows. Secondly, liquidity of the cash, that is what is coming inside and outside, inflow and outflow. And secondly, what is happening on the daily basis, that is known as the operational efficiency. All right, we're done with that, what working capital is. Components of the working capital, the first aspect of the question. The key components of the working capital include bank and cash balances, trade receivables that are also known as the debtors, trade payables which are also known as creditors. Now you can recall it if you have done this in A-levels, definitely, because these were the very scholastic terms in our accounting subject. And inventory, that is the stock. Now, all these terms which I'm using, I'll be explaining in detail in the lecture below. Secondly, these are all from your indicative content as well. That is underneath the specification. Bank and cash balances. This refers to the money that a business holds in its bank account and cash on hand. That is the one which we have reserved, we have saved in our banking accounts. It could be any, it could be capital, it could be saving account, it could be current account, and a cash on hand. That is the one which we are having on our hand at the moment. Management. Effective management of the bank and cash balances involves ensuring that there are sufficient funds to meet short-term obligations without holding excessive amounts that could be otherwise invested. That is, what happens is sometimes we make our money reserve for a very long period of time without knowing its value. We should invest that in some kind of an asset. That is what is the correct value of the asset or the cash management is. Businesses can use cash flow forecasting to predict cash inflows and outflows and maintain an optimal cash balance. That is, your inflow must be higher than your outflow. That is an optimal level of a cash flow management. For example, a retail business might use daily cash flow forecast to manage the cash receipt and from the sales and the payments to suppliers. That is the payment we do to the suppliers because we are getting the raw material and the primary initial products from them. Raw material specifically, ensuring they have enough cost and cash to cover the payroll and other operating expenses. Now, without having money with the hand in suppliers, how they can assure us they're going to give us prompt and timely delivery. So it is very important we should pay them on time, and that is why we should have enough reserve and cash on hand. Clear this one, the first component?
Yes, ma'am, clear.
Yes, ma'am.
All right. Trade receivables, which we know that they are known as debtors as well. These are the amounts owed to the business by the consumers who have purchased goods or services on credit. Now, the word owed, what it means, that is, we as a consumer, we have to pay to the business. We have taken the thing on the lease, or what do we call it, a credit, but we will be paying it afterwards. For example, utilizing the service at the moment, but after 30 days or maybe after 10 days or 1 week, we are going to pay for it. Management. Effective management of the trade receivables involves implementing credit control measures, that is the amount which we are basically we will be receiving as a business owner, as a business, such as setting the credit terms. Definitely, when we credit out something, when we credit out something, there is a thing called that we have to maintain each and everything. That what are the conditions going to be, what will be the terms and conditions, regulations, everything is going to be written in a document. Conducting credit checks, promptly following up an overdue account. That is, if we are not following up a person who has to pay to the business, then we are going to consider him or her as a bad debt. That is, bad debt means he has gone, he won't be paying us for a longer period of time now. He's a kind of a fraudulent person. For example, a manufacturing company may set a standard credit term of 30 days and offer a 2% discount for the payments made within 10 days. They might also regularly review the aged receivables, that is, the bad debt people, to identify and act on overdue accounts. Do you get the example and the concept of the debtors? Who should explain?
Ma'am, I didn't understand the example actually.
All right. Basically, when we utilize a service of any app, for example, a Netflix too, we're not paying, obviously, we pay on a time, then we are able to use the subscription period. But if we assume that first they allow us to use the services and then we're going to pay them, that is going to be a term and terminology. That is, if we are going to pay payback period within 1 week or 10 days, they are going to give us discount. For example, 1 week amount is going to be 1,000 rupees, for example. But due to the discount, we will be paying 800 rupees if we are going to pay on time or within that time period. That is going to be the example explanation. And otherwise, debtors are those things, the trade receivable, that is a term in the accounting in which the businesses, they allow the consumers first to take the product on a credit and then they can pay back whenever they feel like. Clear?
Yes, ma'am. Now I understood. But ma'am, for any other, like suppose this trade receivables or bank balance which are using, mostly like we are depending on the management because in this details are given, like you are giving the definition and even management. Is it totally there's a difference
The term,
between with this management as well?
the management term is specifically by the organization because that is the working capital management. If we go back to the question, managing the working
Yes,
capital
ma'am.
as well. With the components, we have to, like I added it as an extra information for you people so that when you will be doing it in your assignment classes, like when you will be doing the report, it is going to be easy for you. Payables, they are also known as creditors. These are the amounts the business owes to suppliers for the goods or services purchased on credit. Now, the word owes mean the business, like an entity, an organization, they had to pay to the person or to another entity because they have purchased a good on a credit or a lease. That is, in this case, it is a relation of producer to the suppliers. Producers have taken the raw materials on rent, or you can say on lease, on credit, and they will be paying him, the suppliers, maybe after a month or after a 6 month period. It's a contract basis. Management. Managing the trade payables effectively involves negotiating the favorable credit terms with the suppliers and scheduling the payments to optimize cash flow without compromising supplier relationships. That is, you remember my previous lectures, I always emphasize on the term that the relation of the supplier and producer is very critical and crucial. Because if we are not making the supplier happy, they are going to stop the supply of our raw materials and the initiality of the products and how we're going to produce further. So that is why the credit terms are quite critical, but that is how things work. We are not paying them on time, but we try to pay them on time. But first, we always get the raw material. If it is up to mark, if it meets the quality standards of the DQM, then we approve it and pay them, thus pay them to the suppliers, the money for it. For example, a construction firm might negotiate 60-day payment terms, that is 2 months, with its suppliers and carefully schedule payments to match cash inflows from the project milestones. Because we are in, like, if you have a knowledge of the construction, what happened is we are having a lot of money in hand. The one who is a contractor, he has to buy the cement, the steel, and many machinery, wood, bricks, many things, engineers, interiors, everyone. He has to pay them in advance. Only then they're able to work. Now, how things work is they have a credit term between a supplier who is supplying the raw material to the producer. That is, in this case, the constructor. Then, after 2 months or 3 months, he is going to pay back. Eventually, when he is going to get the money in his bank account too, from different resources. That is how things work. That is why cash inflow should always be higher than the outflow. Clear?
Yes, ma'am.
Okay. Inventory, that is the stock. Inventory, the stock management, which is we are having in the warehouses. Inventory refers to the raw materials, work in progress, and finished goods that a business holds for sale. Now, all these terms are different. Raw materials are the initial products which we use to make and process the goods further. Work in progress, that is definitely the things which we utilize during the production of the product. Finished goods, the final product, the one which is with the VPs and the upselling markup prices. Management. Effective inventory management involves maintaining optimal stock levels to meet consumer demand without without tying up the excessive capital. That is, we should have enough stock in hand, even at the backup as well, but not an excessive one that we are bound to produce or give sales and discounts immensely to the consumers. Our ultimate and optimal goal should be to sell out the things on an exact price which we have tagged on our product. The techniques such as just-in-time inventory, that is, whenever you're going to get the order, you'll be making it and producing it and transferring it to the specific person who has ordered it. Economic order quantity, that is a certain quantity which we know that these kinds of consumers, they are going to buy these products and the sales are going to be optimal. Inventory turnover ratios can help manage inventory levels. In the inventory turnover ratios, we are having a lot of ratios. I think we have quick ratio, asset test ratio. These all include current assets, current liabilities. I think in the second lecture, we did the inventory turnover ratios. I don't remember, but I think yes. Otherwise, in the upcoming lectures, we are having specific classes for these ratios. For example, a supermarket chain may implement a just-in-time inventory system to ensure fresh produce is delivered daily, reducing the waste and lowering the storage cost. That is in our the grocery stores. Daily, the vegetables come, the chicken is coming fresh, the mutton, each and everything is coming fresh. Why? Because they know that there is a certain economic order quantity of the consumers which are going to come on a daily basis and they're going to buy and everything is going to be finished. That is why sometimes when we go in at peak hours or in the closing times, things are mostly on discounts as well, like lower prices. Secondly, they are finished as well. Clear?
Yeah, ma'am. Yes, clear.
Yes, ma'am.
Now
Yes,
we are
ma'am.
going to talk about the management of working capital. Effective management of the working capital involves balancing the components to ensure smooth operation and sufficient liquidity. That is, having enough money in hand, cash on hand. Key strategies include the first one is the working capital ratios. In the working capital ratios, we are having current ratio, quick ratio, and working capital cycle. So, what's in the current ratio? This measures the business ability to cover its short term liabilities with short-term assets. That is in the balance sheet, in the statement of financial position, if you remember, that we do have non-current liabilities with the uh, liabilities with, like the one which we have to pay urgently. That is how we are going to, basically those terms are used in the current ratio. And the formula is always current assets divided by the liabilities. And the ratio above one indicates good for liquidity. That is, we are having enough cash in the business, in the organization, so that we can repay the amounts to the one to which we have lent the money. So the ratio, the percentile should be always 1.523, not then like not less than one. It is going to be a dangerous thing. We are going to be less liquidified in the business. Quick ratio, similar to the current ratio, but excludes inventory from the current assets. When we are going to talk about the quick ratio, we are going to eliminate the level of inventory, that is the stock. We're only going to talk about the current assets, less inventory. But in the current ratio, we are having current assets and we're also including the inventory levels as well. But in the quick ratio, we eliminate it. Working capital cycle. The time it takes for a business to convert its working capital into cash. Shorter cycles indicate efficient working capital management. That is, we are working day and night, we are producing everything so efficiently that we meet the level of working capital, that is, meeting and promptly, efficiently the money levels and cash on hand as well. Payment and collection cycle. This is the second management affection of the management. Payment cycle and collection cycle. Managing the timing of outgoing payments to suppliers to optimize cash flow. That is, we have already set a period of time through which we are going to pay to the suppliers. Like in the example, it said that after 2 months, after 60 days, basically, we are going to pay the supplier. So in that period, we will try our best to enhance our statements, income statement, cash flow statement, and balance sheet statement as well. Collection cycle, that is collecting the money from our creditors. Implementing the effective credit control policies to ensure timely collection of the receivables. That is the one through which the people, the consumers who have to pay us because they have used our services or subscription, this is the time when we are going to collect the money. The time is maybe after a month, after a week, or maybe a year. Inventory control. Now, in inventory control, again, we have just-in-time economic order quantity inventory turnover ratio. Just in time, it reduces the inventory holding cost by receiving the goods only as they are needed in the production process. When you're going to get the order, a batch order, only then we will be recalling and calling our suppliers and they will be supplying with the goods and services and we will be producing the specific product. Economic order quantity determines the optimal order quantity to minimize total inventory cost, including ordering and holding cost. I gave the example of a supermarket to explain economic order quantity. We know that like how much thick chicken, mutton, fresh vegetables and fruits are going to be sold out in the day. Only that amount we will be ordering on the daily basis. Inventory turnover ratio measures how often inventory is sold and replaced over a period. Higher ratios indicate efficient inventory management. That is, in our warehouses, we are going to only produce those specific, may not produce, basically, we are going to have a proper check and balance that how much good has been left and how much goods have been sold so that we can have a proper ratio and amount that when we will be producing the next batch. Overdrafts. An overdraft is a facility that allows businesses to withdraw more money than they have in their bank account up to an agreed limit. That is, maybe we want to proceed with merger or acquisition, maybe want to acquire a new project and we need the money. But in our bank account as a business, as an organization, we are not having that much amount. Maybe we're not able to raise up through the investors nor the stakeholders. So what will happen is we will be going to specific banks which allow the businesses to lease up to certain amount. And then we will be having that specific amount, and that is known as overdraft. Management overdrafts can be used to cover the short-term shortfalls. Businesses should monitor the overdraft usage to avoid excessive interest charges and maintain good relationship with the bank. You people already know that whenever we lease an amount, we take an amount from the bank as a loan. What happens is they charge us interest. Sometimes it's double, sometimes it's four times, and we have to repay it on the current date time. That is, if I've taken loan from the bank in 2019 and I'll be repaying it in 2021. So according to 2021, whatever the rate is going on of the currency, I'll be repaying my debt to the bank with the interest charges. Clear?
Yes, ma'am.
Yes, ma'am.
All right. Example business scenario. Basically, we are done with the lecture. This is just the general examples. Consider a mid-sized electronic retailer that has been experiencing cash flow issues. It's a medium-sized organization and it's an electronic retailer. Secondly, it has a problem of cash flow, maybe inflow or outflow. By implementing the following strategies, the retailer can improve its working capital management. Cash flow forecasting. The retailer prepares weekly cash flow forecast to predict cash needs and avoid shortfalls. Now, this is the example which should be like everything is understandable in the above lectures, like in the above slides. But if you have any problem, you may stop me right there, okay? The first thing what he is doing to overpower the cash flow issue is he is making the forecast, the chart, the sheet on the weekly basis now. Secondly, credit control. They introduce stricter credit terms for the consumers, offer early payment discounts, and regularly follow up an overdue account. Now, this means that the organization, the owner, he is going to make those rules and regulations through which the people who have to pay and they are not paying on time, they will be paying on time now because of those stricter actions. That is tougher techniques which we impose on the consumers. Maybe we will be offering the discounts if you're going to pay us early. We will be giving you next time discounts, like these things. Supplier negotiation. The retailer negotiates extended payment terms with the key suppliers to better align outgoing payments with incoming cash flow. That is, they are going to, the supplier, he will try to fetch the amount because he wants that the cash flow and outflow should be balanced in this term, because we are having a problem of cash flow in this specific organization. Inventory management. They implement a just-in-time system to reduce holding costs and improving the inventory turnover, ensuring they stock high-demand items without overstock. That is, they should only have enough items in the warehouse which they can sell out when the demand is high, but not over stocking it up, because ultimately you have to apply discount coupon codes. Effective management of the working capital is essential for maintaining liquidity and ensuring smooth operations. By understanding and managing the components of the working capital, bank and cash balances, trade receivables, payables, and inventory, the businesses can improve the cash flow and operational efficiency. Now, by reading those components, what happened is in an organization as a company, we are improving the amount of flow and outflow, both, and operational efficiency of an organization. Secondly, utilizing the working capital ratios, optimizing the payment and collection cycles, implementing the inventory control systems, and using the overdraft judicially are the key strategies for effective working capital management. That is, if we want to boost up the working capital to an optimal level, then we have to work on these things. And then definitely it is going to be perfect. Now, this is the end of the lecture. From here, this is an example of the your lecture according to the Apple organization. It's a true example. So if you want, you can read it by your own self. We can have discussion in the class, or I can do it right now as well. It's up to you. You can tell me.
Ma'am, you can read any one of the example, and other than we can read it by ourselves. It's okay.
All right.
But I thought, is it like we can use any other companies because they're saying because this example is given by Apple. So that's what I was saying.
Yeah, when you will be doing it in your assignment brief, you will be choosing an SME.
Okay, no problem. That's not a problem. I
Yeah,
am fine. Okay, no problem. Yeah,
because the
no
points
problem.
are same, like bank and cash
Okay.
balances, trade receivables. Only the thing is, it
Yes,
is
ma'am.
according to the organization, what they are doing to make working capital amazing.
Yes, ma'am. No problem.
All right.